Welcome to Opalash TV. I'm in the United Arab Emirates together with Akber Naqvi. He is the Executive Director of Masah Capital, where he's in charge for asset management. Akber, tell me a bit of your history and what does Masah Capital do?
At Masah Capital, we're very niche oriented. We are specialists. We consider ourselves specialist alternative investment managers. So what we've done is, from the beginning, we focused on three specific asset lines that we were going to specialize in. Primarily because obviously the team that's been put together has expertise in those for certain areas, and we feel the team in those specific areas is where we provide the edge as far as returns is concerned and tapping into the actual opportunity available in the markets. So the asset lines that we focused on are private equity, real estate, and asset management. So I'll talk a little bit about each asset line and what we feel we bring in terms of the edge in each specific segment. As far as private equity is concerned, we focus on two primary sectors within private equity, which is healthcare and education. The actual team that is responsible for this has been doing this for the last 10 years in the region, so they're very in tune with how these segments have developed over the last couple of years, almost since inception of these cycles, because MENA markets are still fairly new, and so the team or the CEO of Masah actually has that private equity background as well. And previous institution before he started Masah Capital, they also focused on healthcare and education. So we have a pretty ingrained track record when it comes to developing private equity initiatives in the healthcare and education segments in the MENA markets. So that's what we focus on private equity. When it comes to real estate is a recent venture of ours. Again, it's come through a demand from our investor base as the risk appetite has come back on. Real estate is always considered a very key component asset class in most regional portfolios, but it was distressed in many ways, obviously since 2008. Specifically, if you look at Dubai, there were many distressed portfolios. But I think that emphasis is coming back to look at real estate, be it distressed or be it new opportunities. So I think in the last year, this segment has come more on steam as far as Masah is concerned. We've brought on a team specific to real estate. We have a real estate fund manager who's looking at specific real estate opportunities. So real estate is now starting to develop. When we initially started Masah, real estate was actually not there. We always had the intention of having real estate as an offering, but in 2010 there was no demand for real estate. But we always knew down the line we would have to bring real estate on board because it's a very key component in regional portfolios, and that's what we've done in the past 1 year. We've started to focus on real estate. And then thirdly, obviously the segment that I'm primarily responsible for is asset management. And asset management, again, we focus primarily on fixed income and listed equities. We again have the team and the fund manager has a very extensive background in those asset classes in the region. We've been managing portfolios and managing funds for the past 7 to 8 years. So, for example, the UAE market only started trading properly in 2005, and most of the team at Masah has been trading the UAE market since 2005. So we know the ups and downs of the equity markets really well, and we've managed our return expectations fairly well, even during the boom years up till 2008. But more importantly, after 2008, when the markets crashed, we still managed 10 to 15% returns every year. So we have a very compelling track record when it comes to investing in the listed equity space, and we're intending to develop that part of the business at Masah. And also, fixed income has by default become an important part of Masah Capital. Again, when we started in 2010, we didn't have any intention of focusing on fixed income, but as the market demanded, we had to come up with a fixed income offering, and we did, and it actually turned out to be one of our more successful initiatives. And I think that goes to being a young company and being a dynamic company, that you kind of have to adapt to where the market is going, and we adapted to offering more fixed income, and that worked out well for us. So now fixed income is actually a very important part of our offering, and as we go forward, it will be part of what we offer to our clients as well.
So Akber, you are a MENA specialist. What's your outlook for the region?
We are obviously, as a MENA specialist, we are optimistic on the region. I think it obviously depends on which part of the cycle you're in. When we started off in 2010, the market was still recovering from the crisis, as many international markets have been doing. But now I think we're reaching that spot where the last couple of years have shown that there's some resiliency to this region in terms of the macro, the fundamentals and the pure valuations that you can find in this region. And a few events have happened that have in fact increased the potential of this region. And I think I can be specific in mentioning that the Arab Spring in many ways could turn out to be the most positive thing that actually happened to this region, because what it's done is it's focused the attention of the governments and of public and private institutions of actually developing many aspects of the environment, be it business, be it economic, be it social. And I think that's having a very positive impact on each specific country in the MENA region, and that is translating into very significant opportunities. If you compare our MENA right now, where it stands, to some of the other international markets, it definitely has more opportunity, more potential if you compare it to Europe, for example. I think in terms of Europe, it definitely provides much higher return expectations. Even when it comes to developed markets and other emerging markets, it has inherently got pricing that is still very low compared to where the other markets are. So from a valuation point of view, in any asset class, you're seeing a lot of opportunity in this region. And I think we're starting to see that being reflected in, for example, international appetite. More and more international fund flows are starting to come back into the region because they're seeing that there's a re-rating happening, there's a repricing starting to happen in the asset classes, which is still significant compared to the repricing that is already taking place in the other international markets. So we are very, now especially sitting here in 2013, we are very optimistic going forward as to the inherent potential of this region, simply because now the institutions that can really drive the development of this region, which are the governments, are in completely. You know, they've put in their chips and they're ready to go all in because of the Arab Spring. I mean, I'll give you Saudi Arabia as example. The massive stimulus package that they've come up with, there's a reason for that, because they don't want the Arab Spring to happen. So the residual effect of that, or the trickle-down effect of that massive stimulus, is going to be reflected eventually in the on-ground reality. It's going to be reflected in the earnings of the companies. It's going to be reflected in the different asset classes. And that same phenomena is taking place in the different countries. I mean, you can see, for example, what's happened in the UAE and specifically Dubai. We're sitting here in the middle of 2013, and in many ways, a lot of people are surprised to see where Dubai is, considering where it was in 2009 when the whole debt default happened. So how quickly we recovered and how quickly Dubai started to expand goes back to the inherent potential of this region. The government has massive surpluses because of the oil price, but now instead of spending it outside, they're now spending it in the region. And with that wave of internal investments that is happening, we see many opportunities that any specialist investment manager, if they pick that spots, could come up with really good returns for their investors.
So who are your investors at the moment?
In terms of our investor base, again, it's very interesting how it's developed, and I think it's directly linked to obviously the development of the company and the success of the company. When we started off, even though the team has been in the region for a long time and most of us have a name in terms of the track record we put in place, when you're setting up a new company, it's always hard to accumulate money, and especially this was in 2010. So initially, I think what we had was a lot of family offices and high net worth individuals who had been with us since 2005 and 2004, who had actually seen our track record through the good times and the bad times, and they believed in us. They believed in our investment management skills. So the initial wave of investors that came into Masah Capital be it whichever asset class, were initially high net worth individuals and family offices who were willing to believe in us and believe in Al Masah. What has happened is, interestingly, over the two and a half years as Al Masah has developed, we've increased our AUM as we've become profitable as a company and given back returns to our investors in the private equity space and the asset management space. The structure of the investor base has started to change a little bit, and we're starting to see more institutions starting to come in. And obviously it's very similar to what happens in the rest of the world. When you reach a certain threshold, more institutions start to look at you. So now that we've reached the 500 million mark in terms of AUM, we're starting to see a lot more institutions starting to come into our private equity ventures, a lot of the more institutions starting to come into our asset management initiatives. So the mixture is starting to change. I have to say, as I mentioned this earlier, we do feel that the family offices and the high net worth individuals still have immense potential for us. And even though we are very happy that we're starting to see institutional interest, and obviously we will see more institutional interest coming in as we start to move towards the 1 billion mark, we're still going to cater specifically to the family offices and the high net worth individuals, because there's a specific demand and a specific need that these investor segments need in terms of the offering, especially when it comes to this region. And again, this goes back to where we feel Al Masah can really provide the next evolution of investment management skills when it comes to this region, is being able to cater to this niche segment of the investor base and be able to create a multi-asset allocation model that plays into their specific demands. I mean, I'll give you an example. When you have a family office that is primarily built its wealth on oil and gas, and now it's going into the second or the third generation and it's looking to diversify, it is obviously going to need help in terms of how they diversify, which asset classes they will go into, and they're going to need specialist asset managers who can help them develop this allocation model. And that's where we feel there's immense potential going forward.
So what are some of the new products or funds that you are launching?
We've obviously put in place a UCITS 4 structure because we felt there was a specific demand that could cater to this specific fund, not only in the region but obviously internationally, for international investors who want to invest in the regional markets. And parallel to that, we've obviously starting to see a shift in terms of asset allocation. And initially, as I mentioned, most of our investor portfolios were in fixed income, but now because of yield constraints and obviously risk on environments, we're starting to see a shift back towards more risky assets, including listed equities. So what we did was, we obviously did our research, and we tried to pinpoint a specific strategy in the listed equity space that could be beneficial to our investor base. And what we found is that the dividend strategy, especially when it comes to this region, is a very unique proposition right now that is providing above average returns compared to the rest of the world. And the research actually supports this. So if you can take any research paper, be it regional or international, and you can compare the dividends yields of this region, of these listed companies in Mena, and compare it to the rest of the world, and there's a significant disparity. If you take the top, for example, in the portfolio that we're going to target in our UCITS for Mena dividend fund, we're only looking at 15 to 20 stocks in the Mena region, but they're comfortably giving us a dividend return of between 6 to 7%, which is extremely high if you focus on that particular strategy. But if you take it on a much larger scale, and if you look at the top 50 companies in the Mena region, they're still providing a significant dividend yield of about 4%, which you then compare to the rest of the world. There are very few regions that are coming even close. I think the nearest that comes is maybe the UK, which is close to 3%. But if you look at other emerging markets, even China and India, they're around 2%. So there's a significant disparity in terms of the dividend yields that are being captured in the Mena region. And I think that's because of a couple of factors. One of the reasons is that the listed equity space is still developing, is still nascent, immature in many ways. If you look at the UAE market, it's only started trading since 2005. So what you're seeing is the companies themselves are getting more sophisticated, and they're getting in tune with corporate governance and investor relations, having the right approach to investors, and paying out high dividends is part of that strategy. So more and more companies who obviously have the capability, because their earnings are increasing, their balance sheets are becoming stronger, they believe in the concept of dividends because it directly correlates with the kind of shareholders they have. So you're seeing in companies that not only pay out high dividends, but consistently pay out high dividends. So you're not seeing one year they'll pay one and the next year they won't. They'll consistently pay high dividends over a 3 to 4 year duration. So this is a very unique strategy for this region, and we're tapping into that, utilizing the structure that we have in place, which is UCITS 4, which will make it appetizing for a lot of international investors. But at the same time, we are adopting a strategy that is also that has inherent potential, and has potential that is backed by numbers and is backed by historical records. So if you combine those two together, I think that's a very compelling opportunity going forward, and that's something that we're going to focus on in 2013 and going into 2014, which is this Mena dividend strategy. And so that's something we're focusing on the listed equity space. But in addition to that, when I talk about our other asset lines, we again specialize in the kind of offering we bring to the table. So on the private equity space, we only, as I mentioned before, we only focus on certain segments, and we only focus on, in this case, in healthcare and education. And even in healthcare and education, we are focused on a certain segment of the market. So for example, in healthcare, we will only target the lower to middle class areas of opportunity. So we're not going for the big hospitals, instead we're going for more cash-driven business, which is focused on clinics and diagnostic centers. And that's why, by focusing on certain segments of the market, we're able to give higher than average yields to our investors. And that's one of the reasons why on the private equity space, for the last 2 years, we've managed to pay out dividends, actual cash dividends, of between 7 to 9% on both the healthcare and education, is because we've focused on a targeted segment within that industry, and that's what we intend to do going forward as well.